There are a lot of ways to measure an investment. I've gone over several of them in my 4 Factors of Retirement video and last week's discussion on the importance of proper asset allocation. There's also a lot of potential risks that come along with any investment. Today, we're going to be looking at one of those risks, known as sequence of return risk. We'll be discussing what it is, as well as how to measure and manage it in our own investments. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a 30-day free trial of Audible and 2 free audiobooks of your choice, as well as a list of some books on money I'd recommend checking out with your free trial. So first things first, what is sequence of return risk? In its simplest form, it's merely the risk of an investment having less than ideal returns at a specific point in our investing journey due to the time that we began investing in it. In other words, it's basically expressing the risk that the order of the returns that we receive will not be favorable, even if on paper the overall return at the end of the day is fine. Say John was investing $100 a month into ABC Company, which had a stock price of $100. Let's say that over a 5-year period, ABC Company's stock rose by a little over 50%, but the ride was anything but steady. Initially, John would buy approximately 12 shares, assuming the share price stayed relatively stable. If, by the end of the first and second year, the price of ABC Company's shares had fallen by 20% to $80 a share, and an additional 10% to $72 a share respectively, then John's $100 a month investment would buy him about 15 shares in the second year and nearly 17 in year 3. That's pretty good news for someone in the accumulation phase of their journey, because they're getting more bang for their buck. If ABC Company's shares rose by 20, 30, and 35% in the third, fourth, and fifth year respectively, it would be worth about $151 a share by the start of year 6, and John would own about 68 shares. In total, his net worth would be over $10,300. In this hypothetical, the stock rose by an average of around 9% per year when all was said and done, which is not half bad. But what if the returns had come in a different order? Well, then the situation would be much different for John. Say if we reversed the order of the returns that John originally got. So we have ABC Company growing by 35% in the first year and 30% in the second year. It rose an additional 20% in the third year before finally falling 10% in year 4 and an additional 20% in year 5. John's nest egg would look very different. He'd still be able to buy the 12 shares in that first year before the price changed, but because the price rose after that, he'd only be able to afford 9 shares in year 2 and 7 in year 3. He'd only be able to buy about 6 in both years 4 and 5. In total, he'd own less than 40 shares by the end of his 5-year investing window, and he'd have a net worth of around $6,000, even though the share price at the end was still the exact same at $151 per share. On the withdrawal side of things, the ideal sequence of returns is reversed. Say if John had a $1 million nest egg that was invested fully in ABC Company for some reason, and was withdrawing $40,000 a year from it. If John experienced those hugely positive returns in the first few years, his nest egg would end up being worth a little under $1.4 million by the end of the 5-year stretch. But if he had experienced the losses first, his nest egg would only be worth around $1.2 million, which granted is still more than the $1 million that he started out with, but you get the point. It's still a 6-figure difference in John's ending nest egg after 5 years, just based on what order the returns he got came in. So it's an important thing to be aware of when choosing how to invest your money. With that being said, how do we actually measure sequence of return risk, since we can't predict what the future of any investment will hold? Well, there's no foolproof method, unfortunately, because none of us have a crystal ball telling us what's going to happen with various investments in the future, but there are some statistics that we can look at to give us a better idea of what investments typically have a lower sequence of return risk, and thus allow us to make more educated decisions on how to invest our money. Let's go over a few of the basic ones. The first is the standard deviation of an investment, which measures how much an investment's return deviates from the implied average. The higher the standard deviation, the more volatile the investment, and generally, it implies a higher sequence of return risk. A second number to look at is the diversity of the returns. You do this by examining historical returns of the investment and seeing how many of them fall within certain ranges. We did something like this for the S&P 500 in an earlier video on what to expect when investing in the stock market. Now, admittedly, this is in many ways fairly similar to standard deviation, as it does still measure the spread of the returns. But it can be a little more useful to some investors as you get a good idea of what type of returns you can expect depending on when you invest. For instance, many people use a minimum, baseline, median, stretch, and maximum model of returns when looking at an investment. The baseline return is usually defined as the lowest returns that still fall within the 15th or 20th percentile of the dataset. The stretch return is the highest return that falls within the 80th or 85th percentile. To put some actual numbers to it, on your screen now you see every annual return for the S&P 500 from 1980 to March of 2019, since that's the last completed month I have available to me at the time of this recording. These numbers are based on Yahoo Finance's adjusted closing prices of Vanguard's original S&P 500 index fund, ticker symbol VFINX, and thus it does include things like dividend reinvestment and stock splits. In this dataset, we have 471 rolling one-year returns. The simple average of these returns is about 11.7%. The median is about 13.7%. The minimum is negative 43%, and the maximum is 57%. The baseline return is negative 5.3%, while the stretch is 26.5%. That's quite a darn wide spread if you ask me, and it's what we would expect from an investment that is as volatile as the stock market. Compare this to Vanguard's Total Bond Market Index Fund, ticker symbol VBMFX, which Yahoo only has data on going back to December of 1986. So it won't be a 100% apples-to-apples comparison, but it'll give us an idea of how much investments can differ in terms of dependability. In this particular dataset, we have 389 rolling one-year returns. The simple average is about 6.2% per year, the median about 5.9%. The minimum is negative 3.8%, the maximum 18.3%. The baseline return is about 1.2%, and the stretch is 11.3%. Quite a difference, right? Sure, the highs aren't nearly as high, but the lows also aren't nearly as low. As a result, the sequence of return risk has, historically anyway, been lower for Vanguard's Total Bond Market Fund than its S&P 500 Index Fund. That also means that, historically, the stated annualized average rates of return have been more trustworthy for the bond fund than the stock fund, because the time at which you decide to start investing in the bond fund has had less of an impact on the eventual value of your portfolio than the time in which you decide to start investing in the stock fund. Which brings us to the last question of today's video. How do you manage sequence of return risk? Well, there's the obvious answer of investing more of your money into investments that have historically had more dependable returns, but there is a few other things you can do. The first and perhaps most intriguing and effective option that I won't be going too deep into today because we'll be covering it in a future video, is to alter your asset allocation. Because by investing a portion of your money into various different volatile assets, you can actually lower the overall volatility of your portfolio and potentially even increase your returns at the same time. Though that depends heavily on what time frame you're looking at. Again, that's a much bigger video that'll get its own topic in the future, but I still thought it was worth mentioning. A second option is to invest some of your money into shorter term investments. Some people have created a bond or CD income ladder, where they have at least one bond or CD that's maturing each and every month so that they always have income coming in and won't have to sell off as much of their investments during a crisis. A third option is similar to that second option, and it's to use the 3 buckets strategy, which I already covered in full in a previous video. The basic idea is that you split your investments into a few different categories, or buckets, that each have their own purpose. The first bucket might be used for cash and cash equivalent investments. It's there to cover any expenses that you will have in the near future, usually somewhere in the neighborhood of 1 to 3 years down the road, but some people do it differently. The second bucket might be used for relatively stable investments that are meant to generate some ongoing income for you, that can then be used to slowly refill your cash bucket over time, while still being safe enough that in the event of a crisis, or in the event that you run out of cash in your cash bucket, you can still take money out of here without running too great of a risk of selling the investments at a huge loss. The third bucket is your growth bucket, which is used to invest in more volatile investments that you hope will make you more money in the long term, but that you won't need to touch for several years. Having that longer time horizon will help mitigate some of the damage done by those short-term, day-to-day fluctuations in more volatile investments, like the stock market, since, by and large, they usually do eventually come back to something approximating their average. It's just a matter of how long it takes. Again, for a full explanation of the 3 bucket strategy and how to implement it, you can check out the link in the description below. but that's the basic idea. So there we go. That's a basic overview of sequence of return risk. It's something that every single investment has, at least to some degree, but it can be managed if we're smart with how much of our money we're putting into each investment and how long we're planning to keep the money in there. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.